Welcome back. Markets this morning are lower on this final trading day of September and the third quarter. Take a look at futures indicating a decline of about 130 on the Dow this morning. The S&P down 13 and the Nasdaq down 45. All three major indices finishing higher yesterday, shrugging off any uncertainty about a potential government shutdown. Markets, of course, have been on a tear this year. The Nasdaq is up 17% year to date. The S&P 500 is up better than 13%, and the Dow is up about 9%. For 2025, largely fueled by the AI technology boom. Meanwhile, the White House releasing new details on tariffs going into effect October 14th. That's 10% tariff on imported lumber, a 25% tariff on kitchen cabinets, vanities, and upholstered furniture. On January 1st, cabinets and vanities tariffs double to as high as 50%, while upholstered wood products will jump to 30%. And going into effect tomorrow, 100% tariffs on pharmaceutical companies who are not manufacturing and doing supply chains in America. Joining me now is 42 Macro founder and CEO Darius Dale. Darius, good to see you. Thanks so much for being here. What is your market outlook going into the fourth quarter?
Yeah. So we're incredibly bullish heading into Q4 and beyond, actually, because as we've talked about on your show several times throughout this year, the administration has chosen to outgrow the debt with a mix of growth-friendly policies. And in our opinion, we think markets are likely to be much higher on a 12-month forward basis.
So where do you want to be positioned going into the fourth quarter? Do you want to stick with what's been working? And, of course, that is technology.
Yeah, that's a great question. I think fourth quarter is going to actually be quite challenging for institutional investors because on one hand, we still continue to see the U-shaped economy and slowing to the nadir of that U-shaped economy here in Q4 or in Q4. But the reality is, as we look into 2026, it's highly likely that we have a very robust cyclical recovery. This is the other side of the U-shaped economy you and I have been talking about all year. And so at some point, the market internals will start to rotate to more cyclical, will start to broaden out. And so that's going to be a real challenge for institutional investors to have to rotate into at some point over the next 3 to 4 months.
Well, we're also looking at a macro story that seems to be improving, although questions around jobs. Take a look at interest rates this morning. We've got jobs data out all week today, as well as for the rest of the week. Let's look at that labor data out this week with the August JOLTS report out today at 10 a.m. Eastern, ahead of the September ADP numbers out tomorrow. Expectations call for 50,000 private sector jobs added to the economy. And then, of course, there's Friday's September jobs report from the Labor Department, where 50,000 jobs created are expected. The unemployment rate holding steady at 4.3%. But I've got to add that the Labor Department warned on Friday that the jobs report may not even happen should the government shut down at midnight. Are you worried about a government shutdown?
Well, actually, no. I mean, our research shows that there are only 6 cycles that actually matter to impacting the momentum and dispersion of asset markets on a medium to long-term time horizon. That's growth, that's inflation, that's monetary policy, that's fiscal policy, that's liquidity and positioning. And it's highly unlikely that a government shutdown, however long it may last, materially impacts those cycles and alters their trajectory. So in our opinion, we would be buying any dips associated with any government shutdown.
Well, I guess it depends how long it lasts, though, right?
Well, I'll say this. The longest government shutdown in history, which was December 2018 and January 2019, we saw the S&P 500 rally 10% during the government shutdown. We also saw it rally another 10% in the 3 months after the government shutdown. So perhaps the government should shut down more frequently.
So, again, it was President Trump's term where the Democrats were not going along with his ideas. The Fed cut rates once, but 3 Fed presidents have offered different signals on the central bank's path. In terms of rate cuts, Cleveland Fed President Beth Hammack says that policy is staying restrictive as inflation is above the Fed's target. St. Louis Fed President Alberto Musalem is keeping the door open to further rate cuts but remaining cautious. And New York Fed President John Williams is pointing to easing inflation risks and a softening job market, saying the balance is shifting. A cut in September made sense. Do you think we'll see more cuts this year?
In our opinion, it's likely that we see more cuts because, again, we're still slowing to the nadir of the U-shaped economy. The labor market is certainly taking a real significant step back here. If you think of the last 3 months of private sector labor income growth, which is the sum product of jobs, hours worked, and wages, we are now the worst 3 months we've seen since going back to late 2022, early 2023, when we had the technical recession and regional banking crisis. So it's our view that the labor market will continue to get elevated in their reaction function, maybe not to as aggressive degree as Dr. Moran is articulating. But the one thing I will continue to coach investors to focus on over a long-term time horizon is that there is structural regime change coming for this institution. The next Fed chair is going to be someone who tries to legislate much lower term structure of interest rates, and you have to position for that as an investor.
Well, that's a good point, and that's obviously because President Trump will be appointing that chairman. We spoke with Stephen Myron, the new governor on the Federal Reserve, appointed by President Trump. He was here last week. Here's what he said. Watch.
First of all, I think a lot of folks are more concerned about tariffs driving inflation than I am. I have not yet seen evidence that there are tariff-driven increases in inflation. And it's really important for monetary policy to exit the quite restrictive stance that it's in, because the longer it stays in that stance, the greater the risk to the economy that you do get a material downturn in the labor market that you don't need to experience. In the coming 6 months, I'd like to see us get a lot closer to neutral than we are now. My view is that we can get there in a very short series of 50 basis point cuts, readjust monetary policy.
And do you feel that there's a feeling against a 50 basis points on the Fed board?
Yeah, I mean, very clearly from the outcome of last week's meeting, people don't feel the need to move urgently. And part of that is because they're still very scared of tariff inflation.
Yeah, so they don't want to go 50. They've been doing these 25 basis point moves, so up or down, Darius?
Up or down in terms of the direction of the interest rate?
Yeah. Well, the last cut obviously
definitely
was lower, but I'm saying that it's 25 basis points versus 50.
Well, it's highly unlikely we do 50. There's going to be hardly any economic justification for 50. But in our opinion, that's exactly what you don't want. You don't want to spook the frogs that are being boiled alive in the pot that is the Treasury bond market with regards to inflation. You want to get the term structure of interest rate down in a way that does not, sort of trigger, significant adverse thought processes in the market regarding inflation, because that's what will derail this bull market.
All right, we will leave it there. Darius, great to catch up. Thanks so much. Darius Dale joining us on Investing Today.